Thanks a lot. You define the problem, and he turns it over to me to tell you what to do about it. I guess that's why I have wholly owned subsidiaries, I guess. Yeah, investing in price inflation. First, go to the next slide. We have the typical disclaimers here, the most important of which is past performance does not indicate future performance. However, today we're not going to be talking a lot about investment vehicles or our track record, that kind of thing. It's more generally about how you can invest to protect yourself from inflation. Next slide. This is the same slide Steve had, but I put it in here again just because it angers me and it also kind of cracks me up. I mean, I put in the first paragraph of that headline, which says, from the Associated Press, U.S. consumers paid more last month for food and gas. But outside these volatile categories, inflation was mild. By a show of hands, how many people eat? Okay? So this is why we're concerned. And this is why the EPI was developed. And it actually came from people affiliated with the Institute, either readers, subscribers, or our clients, who would call us kind of angry and saying, you know, what's the Fed talking about here? Well, as Steve pointed out, the Fed eliminates those for a good reason. They want to see the impact of their policies on actual price inflation. So they measure everything, but it's not necessarily what's appropriate for you or what's relevant. So I'll pick it up where Steve left off. Go to the next slide. And first of all, I'd like to talk about bonds. Up until the early 20th century, we were on a gold standard. The world was pretty much. And you could go out and buy British consols, which are long-term bonds. They paid about 4% coupon. And you could be pretty well rest assured that that 4% coupon payment that you got every 6 months, the purchasing power of those payments would be preserved over time. So if you bought a console in, say, 1896, 10 years later in 1906, that coupon, that every 6 month, the income stream that you got would pretty much purchase what it did back in 1896. So the admonition, the premise at the time, everybody said, all you need to do is buy bonds, live off the interest, and never spend from capital, right? That was the guidance at the time, and it made sense because you didn't have to worry about a loss of purchasing power. So that was the rule. Never spend from capital, never sell consoles. There's a funny story associated with that. There was a proper Bostonian family around the turn of the century, and one day the daughter, Emily, was arrested for street walking, for prostitution. So at an urgently gathered family meeting, the father said, Emily, how could you do such a thing? She said, well, you know, I needed the money. He said, well, what about your will? All the money was left to you in your will. And she said, well, that would be spending from capital. So it's considered a rather shameful thing to be spending from capital when all you had to really do was live off of your interest. Now, what about today? If you go to the next slide. Bonds pay a fixed income stream, okay? So if you spend $10,000 on a bond, go out 20 years, you get about 3% these days, not much. But that means every 6 months you get $600. It's fixed, right? So you pay your $10,000, you get $600 a month for the next 20 years. I'm sorry, $600 every 6 months. That's 40 payments of $600. But you're stuck with that $600. Does anybody think that that $600, 20, 10, 5, even 3 years from now is going to buy what it buys today? Probably not, right? So you're fixed. You're stuck with that bond. So bonds are no longer adequate for protecting you against the loss of purchasing power as they once were. So today we're going to talk a lot about alternatives to that. Next slide. So just to put that in perspective, what happened was, with respect to the gold standard, in 1935, the Supreme Court ruled that Treasury bonds are indeed redeemable in paper money. Somebody challenged it and said, no, you can't pay me just paper money. It's got to be backed by gold. And they lost in a 5-4 ruling. Well, what happened since then? Well, here's the nominal, or before inflation, return on long-term bonds between 1936 and 2011. You earned about 5.8%. But after inflation, you lost almost 2/3 of that, of your return. Went all the way down to 2%. Okay? So it has devastated the real returns of your original investment. Some people consider that to be an implicit default. Okay, so we need alternatives is the point. So, and we're going to talk about those alternatives. First, I want to talk a little bit more about bonds. I like the cynical title here that risk-free U.S. Treasury bonds. Yeah, right. I mean, when you go to business school or in economics, they always teach you that the risk-free rate of return is U.S. Treasuries, right? Well, I beg to differ. Now, the story that I told about bonds is quite true in that you are going to lose purchasing power almost certainly. But investors aren't stupid. They know that, right? So what are you going to do if you think that suddenly price inflation is going to be worse than anticipated? If you're going to buy that bond, are you willing to pay the same price? Probably not. You're going to pay less for it, right? If you think, on the other hand, inflation is going to be mild compared to what most people are saying, you might be willing to pay a little more for it. The point is that people build their expectation of inflation into bonds. So it's not like you're instantly getting ripped off. It all depends on the price you pay and what actual price inflation turns out to be. Okay, next slide. So let's take an example here. Post-war years, the 20 years after World War II, and I did a little bit of data mining here to make the point, I admit. But over this particular period, 1948 to 1967, price inflation had averaged about 1.9%. That's not terrible. And it ranged between minus 1.8%. A couple years it got up to as high as almost 6%, but that was an aberration. It was pretty mild, generally speaking, historically speaking, during this period. So you're sitting there saying, okay, inflation's about 2%. I want to buy a bond, okay? So next slide. Over the next 11 years, between 1968 and 79, Treasury bonds returned about 4.1% per year, which included some expectation in the market about what price inflation would have been, right? So people bought that bond back in 1968 saying inflation's been about 2%. They buy bonds, it returns 4.1%. Okay, sounds reasonable. Well, what actually happened? Next slide. Actual price inflation was 7% over those 11 years. I mean, most people here probably remember 68 to 79 was a terrible period for price inflation. Therefore, next slide, your actual returns on the long-term bond during that 11-year period, you lost 2.7% per year in terms of what you can buy, okay? That is not a risk-free rate of return. That is not a risk-free instrument. So in effect, basically, if you had invested $10,000 a year, that would have wound up, in terms of purchasing power, if you had reinvested the interest, you'd wind up with about $7,400 at the end of 11 years, okay? Okay, so next slide. Now let's suppose that you wait a couple of years, you've been burned in this bond, you're going to try it again, okay? And you've had this experience of 7% inflation per year. So now you're going to demand what? Higher expected rate of return, right, in the form of a lower price. I'm not going to pay as much for this bond. I'm not going to go through this again. So the actual returns between 82 and 93, the actual yield to maturity, had you held it for 11 years, you would have got 15.3% per year. Okay? I'm not going to mess around with inflation anymore. Investors demanded this, and if they held it for those 11 years, that's what you got. All right, next slide. But actual price inflation now fell back, still pretty high, but it fell from 7% to 3.7%. Okay? So what happened to your actual returns? Next slide. You wound up with an 11.1% per year rate of return, which is actually pretty darn good for a Treasury bill, right, or a Treasury bond. For something that's free of credit risk, right? It's not going to default, most likely, an explicit default anyway. You got 11%. So let's go to the next slide and review what we just said. We had an 11-year period here between 68 and 79 where you lost 2.7% per year. Between 82 and 93, you gained 11.2% per year. That's this huge disparity in returns, right? That dispersion of returns is what we consider to be risk. It's uncertainty. Okay, that is, so again, I come back to this concept of a risk-free rate of return, and it really makes me wonder. And what it's all about here is what happens between the actual rate of return versus the anticipated rate of price inflation. Is everybody with me on this? Okay, Treasury bonds are not risk-free, and it all depends on actual price inflation that transpires relative to what we thought it would be when we bought the bond. Okay. Now, let me ask you a question. Here's what we just talked about, these long-term Treasury bonds, say 20 years to maturity. Suppose I offer you that, but I also offered you a new kind of a bond that was also had a 20-year maturity, but it had an added feature. Every 6 months, the face value of that bond, which is what you get at redemption, would increase by the rate of inflation. It's going to be tied to the CPI. And every coupon payment that you get every 6 months, that's also going to be tied to the rate of price inflation. Just think about that for a second. Two bonds identical in every way except for that feature. And which would you prefer?
Depends on the rate.
Okay. Well, the point is, most people are typically going to be willing to pay. They're going to pay more for the tips, right? They're going to demand a lower price for the Treasury bond, which means that over the long term, you're actually going to get. You can expect to get a higher rate of return on that regular old bond. It's not guaranteed, though. That's the problem. But for assuming that additional risk, you're probably going to get a higher return. But we don't know for sure. Okay, next slide. And this is what tips. So let me talk a little bit about these inflation index bonds that I just introduced. Unlike conventional treasuries, they do protect against the risk of unexpected inflation because it's actually tied to the actual historical CPI over the preceding 12 months, right? So if you hold it to maturity, you're guaranteed the riskless real interest rate prevailing when you bought the bond. You're going to get the real rate of return, the real rate of interest. That's guaranteed. Therefore, TIPS get a higher price than a conventional bond, and as I say, there's no free lunch. The TIPS have a lower expected return, but you're getting this protection against inflation. That's the trade-off that you're making. Some people, it's more appropriate to buy TIPS because they're very concerned about short-term inflation, particularly elderly people or people on a fixed income. Others who have a longer time horizon might not be willing to accept that trade-off because there's other asset classes that also offer protection against inflation, but in a different way. So let me just summarize in the next slide what I just said to point out the difference between these conventional bonds and TIPS. And these are just depictions. There's nothing numerical about these areas. They just represent conceptually the returns you get. On these inflation-protected bonds, you're going to get the real rate of return, plus you're going to get the actual inflation rate. And there's a little bit of what we call a liquidity premium because there's not a lot of them out there, so they're harder to trade, so you get a little bit more if you're willing to accept the fact that they're tougher to trade. But that's not important. The liquidity premium here is not the important point. So TIPS, you get the real rate plus the actual rate of inflation. With conventional bonds, you get the real rate. You don't get the actual rate of inflation, but you are going to get some expectation of inflation that's built into the price, right, which I talked about earlier. But in addition to that, you're going to get an inflation risk premium, theoretically, because of this uncertainty. In order for me to hold this bond, to accept that uncertainty, you've got to pay me some kind of an additional return, and that's where the lower price comes in, compared with TIPS. So over time, we would expect, in theory, to get a higher rate of return on conventional bonds. However, they're much more susceptible to unexpected inflation. TIPS will give you the protection against inflation.
Won't TIPS give you a protection against inflation as well?
Against what?
Deflation?
Well, they do. At maturity, you're not going to get less than your face value. That's guaranteed. Okay, next slide. Now, TIPS have their drawbacks. We like them for some people, not for others necessarily. Depends on who you are. Again, we have lower expected returns versus treasuries. They still are subject to rising real interest rates, okay, because that was a component of return. As is the case with any bond, if you hold a bond and interest rates go up, the value of the bond that you hold is going to go down because you're subject to a real interest rate that's fixed. Taxes are a little bit tricky with TIPS because every year you are taxed on the increased face value of that bond based on the CPI, even though you don't necessarily get income to offset it. Your coupon goes up, but so does the face value, and you get taxed on both. So it's better to hold these things in a tax-deferred account. And finally, and this is really important, is the CPI versus the EPI. The whole premise of TIPS is that you're protected from inflation, as defined by the CPI, right? But as we know, in terms of people's day-to-day living expenses, the EPI is actually much higher. So it does not provide that sort of protection. So these things are not perfect. Okay, next slide. So as I say, they are the best alternative probably for investors who need an explicit hedge against inflation as measured by the CPI, especially people living on fixed income. They might make a lot of sense. But others, maybe if you're younger, saving for retirement, saving for your kid's college education, 10 years down the road, whatever it is, you need long-term growth, and TIPS may not be sufficient to do that. So let's take a step back and think about generally what investors are after here. We want a portfolio, an investment portfolio, that's going to provide positive inflation-adjusted returns over time. So after inflation, we want positive returns, obviously. We want growth, but we want those returns to be relatively stable as well. Now remember in Emily's day, with the gold standard, that was pretty easy. You just go out and buy the British consols, right? We can no longer do that. And remember, in her day, stocks were considered to be highly speculative. Well, we can no longer afford to simply say that stocks are for speculative investors only. We need something to protect against long-term inflating. Bonds won't cut it anymore. TIPS might help. But there's actually, we have to consider assets that provide positive real returns over time. Okay, and more specifically, if we go to the next slide, we want returns we want assets that provide high expected returns. We want them to be relatively stable and low correlation with other assets. And correlation, just briefly, all that means is that if we have a portfolio, say, with 8 asset classes, we want them all to grow over time. But it'd be nice if we can find some that in the short term are not correlated with one another. In other words, when one goes up, another might be down, or it might be up by not as much. Because if you think about it in theory, that will provide a more stable return in the short term as you're approaching this long-term objective toward greater growth. Does that make sense to everybody? If you have a bunch of assets that over the short term don't necessarily move together, they'll offset one another in the short term. But over the long term, they're all growing. So you get this kind of a pattern, right? And ideally, you find assets that are not highly correlated. Now, there are several asset classes that are known to have low correlations with bonds and with one another, and they're often claimed to be to provide protection against price inflation. And basically, those consist of stocks, commodities, gold, and TIPS. Okay, those are the kind of the common asset classes that people talk about in the media that you should hold now to protect against price inflation, et cetera. Well, to assess this question, we always look at the data. So to frame this, before I start showing you the numbers, remember there's 2 ways to protect against inflation. One is hedging, which means protecting you against the short-term, day-to-day fluctuations in the prices of goods and services. And that's where TIPS we think are well designed. But on the other hand, there is investing for real returns over long periods of time. And those are assets that provide returns over 5, 10, 20 years that tend to outpace price inflation, okay? But not necessarily from week to week to month to month, day to day, do they go up and down with price inflation, all right? Over time, they tend to outpace it. And there's a trade-off between these two objectives. So, I hate to make you look at numbers, but that's what we do. We look at numbers all day, and this is the only way we really have of analyzing this and presenting this. What this chart shows is 3 things. The first thing is correlation with inflation. Correlation runs between 1 and -1, okay? If an asset is perfectly correlated with inflation, it has a correlation of 1. That means that when price inflation goes up by 4%, that asset appreciates by 4%. When price inflation falls by 3%, that asset's return will be -3%. Perfect correlation. if it's a negative correlation of -1, it means it moves in opposite directions. When inflation goes up, the asset goes down. And this is all based on historical data. So we want, ideally for a hedge, you would want it to be positive and close to 1. Okay, that's what this row shows. And I'll talk more about these in a minute. Okay, the returns, nominal returns, are just returns before accounting for price inflation. The average is just the average annual return. So for example, for U.S. stocks, the average annual return since 1926 has been, for the entire stock market, about 11.5%. Okay? And the correlation that I talked about was almost 0. The standard deviation, that's a big fancy term. All it means is volatility. Okay, what range of returns can you expect? The wider the range of returns, the riskier it is, right? So common stocks here, they have a standard deviation of 20%. That means your returns basically have been 11% per year, plus or minus 20%. Think of it that way, about 2/3 of the time. So they range between minus 9% and 32%. That's a pretty wide span. In any given year, you can expect common stocks returns to range between minus 9 and 32%, roughly speaking. Okay? The t-statistic just tells us how valid this data is. If it's greater than 2, we're on solid ground. It's not something just due to chance. And then the real returns are exactly like the nominal returns, except everything is adjusted for inflation. Okay? Everybody follow pretty much what these three things are? Correlation, before tax, before inflation returns, and after inflation returns. Okay, next slide. So let's, go back 1 second to the previous slide. I want to, first of all, let's focus on what we're talking about here. Inflation itself. Again, it's averaged about 3% per year since 1926, as measured by CPI, plus or minus 4%. Pretty good number to rely on. It's been about 3%, ranging between minus 1% sometimes and as high as 7%. So what we're talking about here is a pretty steady data series, okay, that we're trying to hedge against. Okay, now let's go to the next slide. Let's take them one at a time here. I won't hit all of them, but some of the more prominent ones. U.S. stocks, as I said, the correlation with inflation is about 0. Okay, it does not give you a good hedge against inflation from month to month or year to year if you're trying to ensure that your portfolio, if you're spending from your portfolio and you want to make sure that you can keep up with inflation, stocks are not great at that. However, let's skip down to let's first look at the nominal returns have been about 11.5%, plus or minus 20%, as I said, minus 9 to 32%. And after inflation, they're still pretty good, right? You get about 8% per year after inflation. If you think about that, that's a pretty good return. However, the volatility is still pretty high, right? It's going to range from minus 12 to about 28%. Still a pretty good range. So what can we conclude about stocks here? They're probably not a good hedge. However, in terms of providing a long-term positive real rate of return, they're very good, although you have to accept volatility with that. Okay? Okay, next slide. Long-term bonds. Long-term bonds are actually negatively related with inflation. Now, if you think about what I told you before, that makes a lot of sense. You buy that long-term bond, it's fixed. You're stuck with it, right? If inflation goes up, interest rates goes up, the value of your bond is going to fall. It's going to move. The returns on your bond are going to move in an opposite direction from inflation, particularly with longer-term bonds because you're locked into it for a longer period of time. The nominal rate of return has been about 6.6%. After inflation, it gets cut all the way down to 3.2%, but the volatility is still pretty high. It's 11%. So, you know, long-term bonds, they're neither, the way I see it, they are not a good hedge against inflating short-term, nor do they provide very good, very reliable long-term returns after inflation. Now, as you move to shorter-term maturities here on bonds, the picture improves. We go from long-term bonds to intermediate term to 1-year T-bills to 1-month T-bills. At the other extreme, 1-month Treasury bills are pretty highly correlated with inflation. Okay, now why is that? Remember, these things mature in a month. Right? They're going to be repriced instantly to reflect current trends in inflation. Okay? So you're not locked in for as long a period of time. So they track inflation pretty well in terms of correlation. The nominal returns have been only about 3.6% per year, plus or minus 3%, so they are pretty stable. But after inflation, they're not terrific, right? So in terms of a real return, Treasury bills are not good. If you've got a 20-year time horizon investing for retirement, you might want to, we need something other than Treasury bills. However, they are a very good hedge. And look at, just comparing the long-term returns on T-bills of 0.64% to stocks at 8%, it's kind of a no-brainer, I think. Even though you have to accept a lot more volatility over here, if you really don't need that money for 20 years, it's a pretty good bet. Okay, next slide. Now we'll look at TIPS, which we talked about extensively. They have an even stronger correlation to inflation. The data here has only been around, these things have only been around since 1997. It's only 15 years worth of data. So I'm a little bit more hesitant on the data, but they look pretty good. The nominal returns have been strong, actually, 7.5%, plus or minus 5%. After inflation, you get about 5%, ranging from 0 up to 10%, something like that. And they're pretty reliable statistics. I look at TIPS as a good hedge. Longer term, I'm not convinced that these returns are going to be so great. They're still well below common stocks. So I think if you're saving for a goal where you want real growth, like college education or retirement, you still need equities. Okay, next slide. Okay, commodities, of which gold and oil are two, right? There's a lot of commodities. There's platinum, there's agricultural commodities, all kinds of things that you can invest in. Commodities are just the stuff that we make other stuff with, all right? And a lot of people think that these are a good hedge against inflating. Well, if you look at the correlation, it looks pretty darn good for commodities. We've got a pretty good data series. It started in '91. It's a lot closer to 1 than any of these. However, the nominal returns are about 6.7%, not bad. But look at the volatility. They're all over the place, minus 20% up to 32%, something like that. And this T statistic in this case is pretty important because with commodities, in theory, you don't expect a positive rate of return. There's no reason to think that any commodity, oil or anything else, is going to be worth tomorrow more than it is today, wheat or anything else, because it just gets used up. Stocks, on the other hand, combine natural resources and inputs with human ingenuity, right? And they give you a stake in that process. They produce a profit, and they pay a dividend. Okay, so there's actual economic value added with stocks, whereas commodities, it's just stuff. So economists kind of look at this skeptically, and they say, why should I expect any expected return out of these over time? And indeed, the T statistic on this is very low because these returns have indeed been so volatile. So they're not terribly reliable. The real returns on commodities about 4%, plus or minus 25%. Okay, so that's pretty wild in terms of the returns you're going to get. Okay, next slide. Just if you put this on a chart, I didn't talk about gold. If you go back for a second, you can see the numbers on gold are pretty close to commodities. Correlation's lower, it's still not bad. But you get the same story down here in terms of actual returns. So I think commodities and gold are not a terrific hedge, nor are they good for a long-term real rate of return. The distinction with gold that we make, and it's hard to tease this out of the data, but during periods of extreme inflating, you do see gold, unlike other commodities, do extremely well. Okay, that's one of the reasons we hold it. The other reason we hold it is that we think that during times of financial crises, not price inflation per se, gold is a safe harbor investment. So we have people invest between 5 and 10% in gold. Okay, next slide. So just to show you why it's a lousy hedge, if you define a hedge as protection against day-to-day inflation, the returns in blue here, this is the annual returns, or the annual rate of price inflation since 1968. As you can see, that's a pretty steady data series you're trying to hedge against. And you're trying to hedge it with the green bars, right, which are all over the place. I mean, gold ranged between something like this year in �79, it provided a return of like 126%. And 2 years later, in '81, it was minus 33%. So that's a wild range of returns, and you're trying to hedge something that's very stable. It doesn't make a lot of sense as a hedge in the traditional sense. Okay, and then if you go to the next slide, you get a similar picture with commodities. Data series is a little shorter, but clearly commodities are all over the place and inflation's been pretty steady. So they are not the greatest hedge in the world. Okay, next slide. Let me wrap it up by saying, what can you take home from this? You should understand that when it comes to inflating, there's two ways to protect yourself. One is hedging, which is protecting against immediate inflation, sort of on a short-term basis. So elderly investors, people who are relying on their savings to meet their living expenses, should be a lot more concerned with hedging. And you might want to tilt your portfolio a lot more heavily toward TIPS or toward short-term investments like CDs or Treasury bills. And I know they're yielding a negative return right now, but again, you get that stability, and that might be more important to you. On the other hand, if you have that long-term time horizon, I don't think you'd be wise to avoid stocks. And that's not just U.S. stocks, foreign stocks, including domestic and emerging markets. And there is a trade-off between those two, as I pointed out. If you're willing to accept, if you're going to go out and buy an instrument that pretty much guarantees you protection against unanticipated inflating, you're going to give up something for that, and you're going to give up some long-term return. Now, the right asset mix, as I explained, depends on who you are, right? Depends on your circumstances. Again, if you're in it for the long haul, you want real returns. Shorter term, you're more concerned with hedging. And finally, getting back to the story of Emily and not spending from capital. There's a lot of people out there, we've discovered, who still have this attitude that even though they hold stocks in these other asset classes that we recommend, they hold a lot more than just bonds, they should still only spend from dividends and interest. They should never spend from capital. That's still ingrained after decades and decades of experience. That's a bad policy, okay? You hold these assets that appreciate through capital gains specifically to protect yourself against inflation, so it's okay to spend from capital. That's why you hold them. So right now, the problem is you see a lot of people out there reaching for yield. They say, I don't want to spend from capital, and I need more interest income. And Treasury bills or Treasury bonds are only paying 3%. That's not going to do it. So I'm going to invest in high-yield bonds, right? Junk bonds, low credit risk bonds. Bad idea. Okay, you might get a little more income for a while, but they're extremely volatile, and they're the first thing to go in the event of a downturn. Those bonds will collapse. A lot of them will default, and you'll wind up with nothing. Or they invest in high dividend-paying stocks. High dividend-paying stocks per se are not bad, but you shouldn't load up on them just to get dividend interest, okay? They are stocks after all, and they're going to be extremely volatile. So right now, there's a lot of people out there pushing people into their funds because they produce a lot of investment income. Well, invariably, that means taking on more risk, okay? And you don't necessarily want to do that. You have stocks for a reason. It's okay to spend from capital. You just take your portfolio, you spend proportionally, you sell proportionally across all your asset classes to whatever spending level you need, and rebalance it. Keep it in balance. So those are the basic lessons. There's nothing profound here. I didn't present any magic bullets. I hope you weren't looking for one. We deal with reality. And economists don't, and investment advisors, we don't look at an ideal world and say this is the silver bullet. We say, here's the choices before you, and sometimes the best choices are not great. Right now, short-term Treasury bills, CDs, they're providing a negative real rate of return, and that's a lousy choice. The Fed, I left the investment guide with you. You each have one. The lead article is about the Fed, and essentially they've come out and said, well, yeah, we're keeping interest rates low, and we know investors and elderly investors aren't making a lot on their CDs anymore, but by keeping interest rates low, we're going to make stocks do really well. And most people buy stocks anyway. Well, that's a pretty lousy attitude, I think, because they're ignoring risk. They're ignoring the fact that stocks could fall 10, 20% in a very short period of time. How long ago was it? It was just between something like the fall of 2008 and the March 2009, the U.S. stock market lost 30% of its value. And already the Fed is saying, don't worry about it, buy stocks. Well, we don't buy that. So we've presented here a framework. You've got choices. You've got to make trade-offs. We have the investment guide, which we hope will guide you in making that process, making that decision. If you don't want to do it yourself, we have our own advisory services, where essentially we take on the discipline of forming a portfolio for you and keeping it in line with your target allocations. So with that, Steve and I will take questions.